Welcome back to the deep dive. Today, we are taking a shortcut right into the heart of corporate strategy. We're exploring integrated financial forecasting. So if you've ever wondered how these ambitious companies take their big business plans, opening new factories, launching products, and actually translate them into financial statements, well, this is your map.
Yeah, and our mission today is pretty simple, really. We want to understand how companies mathematically model their entire future. And it's not just about predicting one single number, it's about seeing the inevitable consequences of their plans.
Consequences, that's the key, isn't it? The
Uh-huh.
source material really hammers this home.
Yeah.
It's all about causality.
Exactly.
We are going way beyond simple budgeting here. The idea is, if you pull one thread, let's say you increase sales, what are the specific measurable effects on every other number? And what tough choices do you suddenly have to make?
And to do this, we're using a classic case study. The Daryl Company. Management there is, well, they're extremely ambitious.
Say that again.
They've set this huge, aggressive goal, a 40% increase in sales next year. I mean, that is a massive operational leap.
40%.
Yeah.
And based on their first calculations, they're targeting a net income of $46. So today, we're going to trace that ambition, step by step, right through the financial statements to see if that $46 profit requires them to walk off a financial cliff.
Okay, so let's unpack this. We have to start with the income statement.
Mm-hmm.
And the foundational rule here, which the source material rightly calls the king, is the sales forecast.
Always. It all starts with sales.
For Daryl, that means jumping from $1,000 to $1,400. That 40% jump is the absolute linchpin.
It is. If that one projection is off, the entire model,
The whole thing.
the whole thing just crumbles. Every single number after it is wrong.
So once that sales number is locked in, what's next?
Okay, so then we immediately start categorizing the expenses by their driver. And this is where we separate the costs that are, automatic from the ones that require an active decision. Right, so first up would be the sales-driven expenses. The way I think about these is they're sort of automatically programmed into the business. If you sell 40% more stuff,
You have to buy 40% more of the things you need to make it, precisely. For Daryl, their cost of goods sold, the direct cost of the product, it's consistently 70% of their sales.
so it's just math.
It's just math. 70% of the new $1,400 in sales means $980 is immediately gone.
An unavoidable cost that just scales right up with your volume.
Exactly. And you see the same thing with other operating expenses, like admin costs. They're held at about 17% of sales, so that's another $238.
Okay, so those are the easy ones, the straightforward connections. But this is where it gets interesting, right? Where we stop just multiplying percentages.
This is the pivot. We shift to what we call policy or asset-driven expenses. These are expenses that management chooses to incur, often years in advance. They're tied to long-term assets or financing decisions, not just today's sales.
Hang on. So if I sell 40% more widgets, that doesn't automatically mean my depreciation expense goes up.
No.
I always kind of assumed if business was better, all my costs went up.
And that's the common mistake this whole model is designed to correct. Your depreciation expense, that's just the accounting for the wear and tear on your factory, your equipment, your PP&E.
Okay.
You pay for that factory whether you sell 1 unit or 1,000,000. The cost is driven by the fact that you own the asset, which is on the balance sheet.
Not by today's sales.
Not at all.
Wow. Okay. So that makes perfect sense. It means the income statement, which tells us how profitable we are, it actually has to stop and wait for a number from the balance sheet before it can even finish its own calculations.
And that is the first big flashing sign of integration. It's a loop.
And I guess that applies to interest expense too.
Absolutely. Interest is driven by your level of debt, which is a financing choice recorded right there on the balance sheet. If Daryl takes out a new loan, interest goes up. It doesn't matter what sales are doing.
And then the final piece is the profit-driven expense income tax. That one's simple enough.
Yeah, that's just a fixed percentage. For Daryl, it's about 43% of whatever the company makes before tax. So now we have a clear causal map for the whole income statement. But to get the final numbers for depreciation and interest,
We have to go to the balance sheet.
we have to forecast the balance sheet to see what Daryl has to buy and how they plan to pay for it.
Which takes us right into part 2, forecasting the balance sheet. We have to figure out what happens to all the assets and liabilities when Daryl hits that crazy 40% growth.
And we do the same thing. We separate them into 2 buckets. Spontaneous items versus strategic decisions.
Spontaneous is what just happens.
It's what happens automatically to your balance sheet when you hit that sales target, assuming you keep running the business the same way. You become like you said, a financial prisoner of your own success.
And maybe a very expensive prism.
Yeah.
So talk us through the spontaneous assets that have to grow by 40%.
Okay, well, if sales jump by 40%, you're inevitably selling more on credit. So your accounts receivable, that's the IOUs from your customers, it has to grow by 40%.
Makes sense.
To support that higher sales volume, your inventory on the shelves also has to grow by 40%. And you'll probably need more cash in the bank just for day-to-day transactions. In Daryl's model, all three of those current assets grow automatically at that 40% rate.
But on the other side of the sheet, on the liability side, this growth cycle gives you a tiny bit of help, right?
A tiny bit, yeah. Accounts payable is also spontaneous.
Because you're buying more stuff.
You're buying 40% more raw materials to fuel the sales, so your suppliers naturally give you 40% more credit.
So that helps fund a little slice of the new asset.
A little slice, exactly. But it's rarely enough, especially when growth is this fast. And this is where the automatic part stops, and management has to start making some big strategic calls.
Right. We're talking about the long-term planning and discretionary items. These are the accounts that need specific, active decisions. They don't just follow the 40% sales rate. And the perfect example is property, plant, and equipment.
It really is. Daryl's 40% sales jump requires more than just, squeezing a few extra shifts out of the old factory. The source material is clear they're planning a major capacity expansion. So PP&E isn't just growing by 40%.
It's a specific jump.
It's a huge jump from $300 to $500.
So that's a $200 capital expenditure. That is the definition of a strategic decision.
It is, and it dictates the need for new funding, and crucially, it's what drives that depreciation expense we talked about a minute ago.
Right, the loop.
Mm-hmm.
And I assume financing choices like bank loans or issuing new stock are also discretionary.
Completely. Management has to actively decide how to pay for that big expansion. The forecast will show them how much they need.
But they still have to go out and get it.
They still have to get it.
So we have this mix. The operational stuff growing spontaneously, and these huge investment and financing items growing based on specific plans.
And now we have all the pieces. We can finally put the two statements together. Which brings us to part 3, and this is really the climax of the whole analysis. The integrated model, or what people often call the loop.
The loop.
The statements have to be iterative. They have to be consistent. One feeds numbers back to the other until everything is perfectly aligned.
Okay, let's trace that loop one more time, because this is where the big reveal happens. We took the strategic decision bumping PP&E up to $500, and that number feeds back into the income statement.
Yep, to calculate those policy-driven expenses. If the historical depreciation rate is 10%, that new $500 PP&E level drives a $50 depreciation expense.
And then the loop continues immediately with the income statement's output.
Mm-hmm. Once all the expenses are calculated, the income statement produces the net income. In Daryl's case, that's their $46 target. And that $46 flows directly back into the balance sheet.
Where it increases retained earnings.
Exactly.
And that $46 is so important because it's funding generated internally by the company. It helps pay for those new assets.
It's a critical piece. If the profit was only, say, $10 instead of $46, they'd have way less internal funding.
And the gap we're about to find would be even bigger.
Much bigger. So now, the moment of truth. The fundamental rule of accounting is that the balance sheet must balance. Total assets must equal total liabilities and equity.
No exceptions.
We've calculated exactly how much asset growth is needed, both the spontaneous and the strategic parts. Total forecasted assets sum up to $864.
Okay, $864. That is the bill they have to pay to get their 40% sales growth.
That is the bill. But if we total up the funding sources they already have...
So the spontaneous liabilities plus that $46 profit.
Right. That subtotal comes to only $346.
Wait, hold on. They need $864 in assets, but they only have $346 available internally.
That's the problem. That leaves this massive, unavoidable funding gap.
Of how much?
$518.
Wow. $518. That is, that's staggering.
That 518 is the critical plug figure. It's the number that represents the external financing needed. Management is forced to make a strategic decision right now. How are we going to plug this hole?
And in the Daryl case, the assumption is they cover that entire $518 gap with new bank loans.
Right, which makes their new total loan figure $824. And that is the most revealing number in this entire exercise.
It has to be. The plan to grow sales by 40%.
It necessitates securing over $500 million in new financing. The forecast is like an alarm bell. It tells the CEO, your ambition requires you to go to a bank and get a $500 million commitment based on a prediction.
That plug is a future action item highlighted today on paper. The plan is dead unless they can secure that financing.
So why does all this, this complex looping and categorization actually matter in the real world?
Yeah, what's the point?
Well, part 4 is all about utility and risk assessment. The number one value of creating these pro forma statements is just to force management to think through the consequences of their plans on paper.
Before they commit real money.
Before they commit a single dollar. It's the ultimate alignment tool. It links the 3 pillars: your operational plan, your investment plan, and your financing plan.
The sales goals, the PP&E jump, and that huge $518 plug.
Exactly. And if that financing plan isn't realistic, then the whole operational goal of 40% growth has to be scaled back.
And it's not just for the internal team, right? Who else uses these forecasts?
Well, there are 3 key user groups, and they all care about something different. Management, as we said, they focus on strategy, making sure they have enough cash.
Okay.
Then you have the bankers, the creditors. They look at that massive $824 debt figure, and they only see one thing: credit risk.
My question as a banker would be, can Daryl actually generate enough cash to pay me back?
That's all they care about. They use the forecast to calculate coverage ratios. And then finally, you have the investors.
And they're looking at future stock prices.
They're using these projections as the foundation for valuation models to figure out what the company is going to be worth. They have to decide if the risk of all that debt is worth the potential reward of that $46 profit.
But that $46 profit, it's just one possible outcome. It's the target. The reality is uncertain. What if sales only hit 20%?
And that is why a single forecast is never enough. It's just a best guess. Smart analysts have to run a sensitivity analysis.
So you create a range of outcomes.
A crucial range. Instead of betting everything on that standard case, you model a worst-case scenario, pessimistic assumptions, and a best-case scenario with optimistic ones.
So that changes the whole conversation.
Completely. If the standard forecast is $46, but the worst case is a loss of -10, and the best case is a profit of $120, now you understand the volatility. Now you can assess the real risk of taking on that massive loan.
Right. The question shifts from, do we go forward, to something more like, can we tolerate a $10 million loss and still make the interest payments on $800 million in debt?
That range is transformative for managing risk.
But there's one last catch, isn't there?
There is a final, crucial limitation. The income statement only shows profitability. It doesn't guarantee cash flow.
The dreaded profit but no cash scenario.
Exactly. If Daryl makes $46 in profit, but all those new sales are on credit, the cash hasn't actually arrived yet. They could run out of operating cash while looking profitable on paper.
A liquidity crisis.
Which means the job isn't done until they also forecast the statement of cash flows, just to confirm they can actually pay the bills.
So let's try to synthesize all this. Integrated financial forecasting is this disciplined, causal, and deeply strategic process. It weaves together the operating assumptions, like that aggressive 40% sales goal with big investment decisions like the $200 factory expansion.
And by doing that, it forces the revelation of these critical financial needs, like that massive $518 plug. It tells management that their ambition has a very real price tag, and it demands action long before the plan actually starts.
And the math itself is pretty straightforward. But we have to remember, the quality of the forecast and maybe the stability of the entire company is only as good as the assumptions you feed into the model.
Absolutely. So that brings us to our final thought. If you were the manager at Daryl Company, looking at this whole plan and the sudden need for a huge new loan, which single underlying assumption, the 40% sales growth, the 70% cost ratio, the $200 PP&E jump, or even the stability of a 10% interest rate, which one would you immediately challenge? Which one would you test first with a sensitivity scenario before you risk $518 million?
That decision right there is the very essence of strategic financial planning.